Thank you for joining the Small Business Boot Camp for this Tuesday, September 19th. As I say, it seems like every week the time is just flying by. I can't believe we're already past the middle of September. But something we've started to do that I was one of my favorite parts about the boot camp is that I like to have everybody, while we're getting started, post in the chat where you are tuning in from. So I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services, and I am tuning in from our offices in downtown Phoenix today. And I see we have Spencer from Goodyear, we got Tucson, Danny's from Tucson, Phoenix, Chandler, got Robin Reed, all right. Tucson, Yuma, Camp Verde, Sedona, more Tucson, Chandler, Flagstaff, Globe, Chandler, Phoenix, Tucson. We've got a large chunk of the state from Tucson to Flagstaff and over to Sedona. We got Peoria, Buckeye. Excellent. And I know we'll have a bunch more jump in here shortly as we get started. I've noticed a lot of people like to not listen to me and join about 5 minutes late, and that's so they don't have to hear me and they can hear the main speaker, which is okay. If you're with us often, you hear me every week, and it's a very similar intro. But I appreciate everybody being with us today. As we like to do, we like to start by thanking all of our community partners. We could not do these webinars without them, their time, their effort, and their expertise. And this is just a sample list of the many partners that we have that have helped us over the 3+ years of doing the boot camps. So for those new and are not familiar with the Small Business Boot Camp, it is a webinar series designed to help small businesses prepare, plan, and grow. We host the webinars every Tuesday morning at 9 a.m. And occasionally we'll have some special sessions, which we have one coming up in October that we will share more on as we get a little bit closer. But we do special sessions, we do some additional workshops with other community partners and local leaders. And then a great tool that's part of the boot camp is our content library. So we take all of our webinars that we do, we record them, and then we post them in the content library, and this is available to everyone at no cost. You can go on and see. If you can't make it on Tuesday mornings, you can know that it will be available in the content library for you to view later in the day or the following day when it's convenient for you. But you can go back and look at any of the previous sessions and find out information, watch the video, download the slide decks, and any other information the presenter wants us to share there. So even if you watch it live, you can go back in a day or so and download the slide deck if there's key pieces in there that interest you. So it's a great tool. The Arizona Commerce Authority also has some other programs that help support small businesses. Our Career Readiness Credential Program, the Arizona Innovation Challenge, Arizona MEP, Manufacturing Extension Partnership for small to medium-sized manufacturers, the Arizona State Trade Expansion Program, Easy Step, Arizona at Work, and then our Small Business Services, which I oversee, and we can help with all kinds of different small business items that you may have. One of those items is when you're looking to start or expand your business, we have our small business checklist, and it helps entrepreneurs understand the commonly requested licensing, registration, and compliance needs at the local, state, and federal levels. And so it's a great resource to go into. You can get the very detailed information on our checklist, but also on the checklist page for quick, shorter bits of information. You can use our virtual assistant, Sally. Sally is for state and local licensing information. So we have both those options, the web page with the smorgasbord of detail, and then our virtual assistant for the fast food style quick information. So we'd like to share some updates with people. We've got some great updates. In September is the Entrepreneur Speaker Series by the State 48 Foundation. It's a great series on Wednesday evenings throughout the month of September. If you get a chance to check that out, we're going to post the link for this information in the chat, so you can click on that and get that information. Another very important items to make everybody aware of is last week the IRS stopped processing ERC applications, the employee retention credit, amid lots of challenges and warnings and fraud. And so they're very worried that about the program and businesses being taken advantage of by some of the less trustworthy processors, people that are trying to take advantage of small businesses through the ERC program. So they made some changes to that. We're going to post up the official links in the chat so you can find more details on that. But that is something to make everybody aware of. So if something you were in the process of doing or thinking of doing, just you can get more details. And then we just we'll post the link for this as well. We'll be doing a small business workshop that's in person only with the Arizona Commerce Authority and the Phoenix Business Journal on Wednesday, November 8th. That'll be from 9 to 11 a.m. in person. It's on for focusing on existing businesses on how to grow as you look forward with your business, how to grow, and things to be aware of as you're growing your business. So we're excited. This is the fourth one of this year, and we've got 2 great panels set up, a little bit different format than the past, but we're really excited about it. So we can hope you can make that. So with that, we're going to look at our upcoming sessions. We have our next week's session is a playbook for an entertaining social media game. This is with Jeremy McPeak. He did the social media for the Arizona Super Bowl host committee and is also working with the Arizona Final Four host committee on their social media. Very great presenter. And then on October 3rd, we're going to have building Facebook ads that work for small businesses. And then on October 10th, navigating cash flow. So we've got a lot of great upcoming sessions that we can hope you can join us for. But again, we will record them and they'll be in the content library if you can't make those specific dates. But with that, we're going to jump into today's session. And today we're going to talk about things that you need to know or your underwriter wants you to know when it comes to lending. And we have Danny Nee, the Executive Director of the Community Investment Corporation. He works with businesses in the Tucson metro area in southern Arizona. So Danny, I'm going to stop sharing my screen and turn this over to you.
Awesome. Thanks so much, Robert. Really appreciate the chance to be here today. I hope everybody also on the webinar knows just how committed you are to this work. You and I have spent weekends together judging pitch competitions and stuff. So thanks for that. Is this the right share? Are we doing all right? Or?
Yeah, you were on the Who We Are slide.
Awesome. Great. Thanks so much. So just quickly, my name is Danny Nee. I'm the Executive Director for Community Investment Corporation. We are a 501c3 nonprofit organization. We're based in Tucson. We serve mostly southern Arizona. We have 3 different programs, and it's really about access to the economy. We do that through homeownership education. And then, of course, what today we're here for is entrepreneurship. And in that way, we also focus really on the lending side of things. So there are lots of amazing business educators that are out there that we partner with, but we focus more on actually doing lending. So that's good to know just a little bit about who it is that's talking to you today. Here's what we'll cover. We're going to go about 35 minutes or so in content, 35 to 40 minutes, leave 10 to 15 minutes for question and answer. Quick little bit about the context and the different types of funding. We're mostly going to be talking about traditional debt funding today, that sort of financing and how underwriters look at that. There are certainly other types of funding. We're going to look at, just quickly, what is underwriting, and then what's the underwriter's mindset, which I think is actually, hopefully I can give you some insights. I think that's where a lot of tension or friction actually happens in what a business person's mindset is when they're going in for a loan, and then understanding what it is that an underwriter's job is and where they come at stuff. We will touch on the 5 C's of credit. You can't get through underwriting without that. Many people, I'm sure, have already heard of that. And then we'll talk about some key ratios. Again, we have a short period of time, so we're not going to get deep into it, but we'll talk about just some of the most important ratios At the end, there are going to be, you can see there's some resources where I think this will just touch on some things, and then you'll want to hopefully go a little bit deeper. You can Google stuff and use some of those resources that I have there. Also, we'll talk about just, not just underwriting, but how it is that you would apply, like before you apply, what sort of documents are you going to be asked for, and then a little bit about what is being loan ready versus not being loan ready, and then hopefully some Q&A at the end. So we'll hop in here quickly. This is some part of the mindset of an underwriter and why it matters. Your view of your business, hopefully. I always say that I really want optimistic business people. It's like, yeah, this is going to be amazing. We're going to make money. I have this great idea. Things are going well. And while I'm joking a little bit, the underwriter's view of your business is like, yes, they see the potential, but they are looking for risk all the time. They're looking for all the disastrous things that can happen. And so you, in some ways, as the business owner, if you are applying for a loan and want to get that loan, you have to understand that the underwriter may be a little more pessimistic than you are. And they're looking at what are the red flags, what are potential problems. And we'll talk about why it is that they do that also. There's a reason for that, and a good reason, actually, in terms of what they're required to do. In terms of the different types of funding, again, we are going to be focused more on the left side here, the traditional term debt. And what I want you to think about this in terms of types of funding is how the people who are looking at that funding, where it is they look to get their information and what they care about. If you are a business that's looking for an investor, something like an equity investment, you're a high growth business, venture capital or an angel investor, they're often looking at the potential. They want to know, who you are. It's not as if you can just show up one day and it's only about the good idea, but they are more focused on what is the potential of your idea and can you get there? And they are looking like a little bit into the past, in the present, and then a lot into the future. A traditional term debt lender really looks backwards. They look a little bit at the present. They might look a little bit into the future in terms of maybe what a loan is going to help you do with your business to grow it. But most of what they are looking at looks backwards. And it's important to know that, because a lot of times, again, the perspective of a business owner is to look forward, to be optimistic, to think about, I have this amazing idea. I figured out something else I can do with my business to grow it. And the reality is that underwriters and lenders are not as interested in that. And one of the reasons they're not as interested, there's a reason. It's because if you have a million or $1 billion idea, I hope that you do, a lender is not going to benefit at all from that. They have a set amount that they are going to make off of you, whether or not you have the most successful business ever. And so they're only focused on repayment. And the way that they work on that, as we'll talk about a little bit more, is looking backward on past performance. And so, again, it's good to understand the difference in perspective when you come into this. I did put this bottom part down here, the revenue-based finance and nonprofit alternative lending. We do some of this where we try to balance that a little bit more, where we're not just looking backwards, but we're also looking a little bit ahead. Most debt lending is based on a few things. It's really about your collateral. It's about your credit history, and it's about the current performance and past performance of your business in terms of how much money you're creating to be able to potentially pay off a loan. And some of this, the revenue-based finance and nonprofit alternative lending, looks more cash flow and has a little more of an eye towards the future than traditional debt lending. But again, we're mostly going to talk about traditional term debt. And a term loan is something, it's like, hey, I borrow $100,000, $10,000, and it has a term 5 years at this percent, payments of this much. Okay, so what is loan underwriting? And I think that's we throw that term around a lot as it's like everybody just talks about underwriting all the time, those of us who work in lending. And I think it kind of sometimes means different things almost to different people. In the term of lending, underwriting is the process of assessing risk. Okay, it's the risk of any given investment by a bank. If I as Community Investment Corporation, I'm representing Community Investment Corporation. We before we give money out, we want to really assess like how likely is it that that money is going to get repaid. Um, and so that is why, that the first sort of like with the tornadoes and stuff, underwriters are always looking at the risk. They're always looking at what might go wrong, what might prevent a business from potentially not paying back that investment. Underwriters analyze financial and other information. They focus mostly on financial information, but they will look at other things. But I also want to highlight again, even in the 5 C's, 3 of them are really more important. People may not admit that, but they're really what most of underwriting is based on. And I'm trying to talk a little bit from, again, traditional lending. We do some alternative lending, a little bit of a blend. That's my perspective on this. But the focus is on repayment. And in the case of that a loan can't be repaid because something went wrong with a business, whatever it is, then an underwriter wants to look at how do they cover the value of the loans in the case a borrower is unable to repay. And most people will understand that that comes in the form of collateral or guarantees. But that is really where their focus is. Again, it's not on how good your business is going to be. It's not even necessarily, that altruistic, like, well, this is good for the economy and those things. Lenders have they have a self-focus to be looking and protecting their own investment and hopefully making money off of that for traditional banks and lenders. Nonprofits like mine are a little bit different in that we don't necessarily, as I like to say, we don't have to make money, but we can't lose money. So we do focus on some of the same things in terms of being careful in terms of how we get out money, because we can't have that we can't lose that money. We need that money to lend to other businesses. So here again is kind of the mindset of an underwriter, and this is generally I'm generalizing. I'm not talking about every specific type of underwriter, but they care about your performance. And again, it's mostly past performance or how you're doing right now. And they don't care about your potential because they are not going to benefit from your potential. No matter how big your business gets, they are only going to earn a set amount and they only care whether that gets repaid. You should also know that they rely on the past to predict the future. And so this is why credit histories, people talk about it, and even the past performance of your business is really important. Generally speaking, they really want to see 2 years worth of positive performance, where you're profitable, and you're able to hopefully take on a loan to grow. They also crave consistency. And this is something I was talking to the person who does the most of the underwriting for us, our Chief Operating Officer, Caroline Nelson. And she said, what's really important is that the story that you tell when you get in front of a lender, when you're talking to them, is consistent with the documentation that they are going to check. And so what it may mean in some cases, I don't think, people particularly are like making up stories or lying to us on purpose. But if you don't understand what an underwriter is going to ask for, and you don't then understand necessarily what those documents are telling, the story that they're telling to an underwriter, you can get into a little bit of trouble if you're telling that story in person. And that's generally a part, unless you're using online lending, that's generally a part of the underwriting process, is to meet with the business owner. They want to know that you know about your business. They want you to be honest and upfront. If you don't know an answer, if you're not sure, you should tell them that you're not sure. But don't necessarily make up something that you don't know for sure, because it generally comes out in looking at the documentation. They're also going to prioritize documented data over all else. And I say this, and I try to say things where are they're hopefully a little bit memorable, but the idea, you sometimes see in like movies or something, people get all dressed up with a tie, and they go in and they want to look all, squared away as they get in front of somebody. And the reality is you could probably come in dressed any way that you want. And if you look really good on paper, that is more important to an. Now, that is again not to say that the personal side and having a relationship with a lender can't be important and can't help. But at the end of the day, underwriters are looking at what is documented. Also, just if you haven't gone through this, you should know that underwriters are always they're also going to look at your personal wealth and performance, your own personal credit score, and those types of things, as well as your business performance. While there are LLCs, limited liability companies that, make it so that your personal wealth isn't tied up with your business wealth, the reality is that underwriters want as full a picture as they can get to figure out what kind of risk you are. And so if you have problems with your personal credit, fair or not, that winds up spilling over into whether somebody may give you a business loan or a business line of credit. And so it is important just to know that if you're wondering, well, why are they asking me about, why are they asking about what I own, my house? Like, that's not part of the business. They're trying to figure out what your personal financial outlook looks like. They're also looking for potentially the collateral that you might be willing to pledge in the case that a loan isn't able to be repaid. Again, underwriters are looking kind of backward. They're looking at sort of the downside of stuff. They're a little more glass half empty than half full. And so you have to understand that as you're going in. And what they also want to know, generally speaking, is that you have something invested in your business, like your own resources, and it's not something that you could easily walk away from. Even the idea of like, well, my business is really important to me, but I can no longer do it, and I just close up shop, and you still owe a bank or a lender. They want to know potentially that you have something else at risk. And that's how the personal kind of comes into the business as well. And they may ask you to put a personal guarantee, or they may ask you to pledge, real estate that you have, if you have that. And these are, again, they are trying to minimize risk. I do think they're trying to be fair, but at the same time, they would prefer that that more is in their favor than is in the borrower's favor, and they'll try to get you to pledge as much collateral to secure the loan as possible. So the basics, and these are the 5 C's of credit. If you can type this in, Google it. There are a million sort of things on it. All lenders basically talk about it. I really think that there 3 are really what are focused on mostly. First is like the capacity. So that's, it's your debt to income ratio. It's how much money you're making in your business. In some ways, it's like the performance side of this, how your business is doing, and what other debts it may have. They call it character, which is interesting because character-based lending is a thing now, and it's not talking about the same thing as like credit history. But in the case of the 5 C's, mostly character means how have you done on with previous debt that you've had. So how good have you been paying off that debt? And they care very much about that. Most places pull credit scores. They look at your debt. They want to see how you've done. In our society, in our economy, credit score is, I would venture to say that's overused for so many things. People use it for applying for housing and even for jobs. People can check your credit score to try to they use it as a proxy for responsibility. And so this is one that, again, if you don't have good credit, it's very, very hard to get a loan. This is what underwriters focus on. And then the last one is collateral. There are certain, loans that are given that are not collateralized. They don't have an asset to secure them. And basically what it is, again, I know there's probably a wide range of people on this call. Collateral is basically anything of value that you're pledging to the lender in the case that you can't repay the loan. So something happens, COVID happened, and this was something that happened to a lot of businesses, unfortunately, and they couldn't keep their doors open, and they may not have been able to make their payments. And the way that banks and some people were made whole, the lenders were made whole, was going and collecting that collateral. Somebody had pledged, and a lot of times it's generally a real estate, it's a building that's owned, or furnitures, fixtures, and equipment, FF&Es as they call them, all the things that are part of your business. Then the lender is entitled to own all those things, to sell them off, to try to then to basically make themselves whole. Collateral is one, it's big. It's also something, again, where a lender and an underwriter sees that you have skin in the game, that you have something to lose. They don't want their money to be the only thing to be lost if somebody goes out of business. They want to make sure that people are committed to making their business work. The other two are capital. That is the money an applicant may have. It can be in terms of the assets that a business has. It can be the cash, all the other things that a business may have. Capital, in my opinion, goes partly into capacity, but it's considered its own section. And then conditions, things like, well, what is the purpose of the loan, the amount involved, how much is that going to cost? It's sort of the levers that people pull to try to equate the risk that they see, an underwriter sees, with the cost of getting the loan. And there are lots of different things that can go into this. Another big thing that people look at in underwriting is they look at experience in the industry. If you're, how long have you been doing this? If it's a newer venture, how long have you been in it? They want to make sure that you know what you're doing. If you were a poet and suddenly you're trying to start up a tech company, they want to know how it is you have the skills to do that per se, and they generally want to see some experience. Okay, some of the key ratios, and there are actually lots of ratios that underwriters will look at, and they are kind of esoteric at times. They can get into pretty deep detail, but I do want to just cover some of the sort of basic key ratios. There's also a resource at the end where you can go look out online and you can see some deeper descriptions of these, as well as just some other ratios that underwriters will look at. The number one ratio that I've seen that's looked at is debt service coverage ratio, DSCR. And what it is it measures whether a business can generate enough cash to service its debts. And so basically what underwriters are looking at is how much cash is being generated. Normally we're talking about net revenues that are being generated by the business. And how much is that, versus how much debt that they have and how much those payments are for the debt. So normally the best that people are looking at in traditional banks, they're looking for a debt service coverage ratio of 1.25 to 1.5. And well, what that means is basically you're looking at a 1.5 ratio would be that you have $1,500 of net cash. So and net cash is revenues minus, your business expenses. That's being generated, let's say, every month to pay $1,000 worth of debt. And the reason is the reason it's not one-to-one. You're like, oh, well, why isn't it just like if I have enough money to pay the debt, then it would be, one-to-one. It's because they're building in a cushion basically in case your business doesn't stay doing as well as it is. And so what they're basically telling you is they want anywhere from a 25% to a 50% cushion on that to make sure that you can pay your debts. And again, it's the number one thing. It's all your debts combined. They don't just look at, hey, here's what your revenue is and here's the amount you want to borrow. They want to know how much other money you have that's already basically going out the door. Many underwriters also look at something that's called a current ratio, and this is what I'm saying. It gets a little bit kind of esoteric and further down the weeds. They will look at things like how much of your debt that you have is due in the next year to make sure that you can make the payments for any loan that they're making. And oftentimes the debt service coverage ratio, it will determine whether you can get a loan at all, but it will also determine the size of loan that you can get because again, lenders are going to try to keep you in this range of 1.25 to 1.5 ratio in terms of the cash coming in versus the payments for debt that need to go out. Loan to value, and there are underwriters that look at this really in multiple ways, again, depending on who it is that you're working with. A lot of people think of loan to value. If you bought a house before, you probably understand loan to value. It's hard. Banks and lenders don't generally want to give 100% of the amount that something is worth out in a loan. There are several reasons for that, including if things went sideways really quickly, they wouldn't be able to recoup all that. Again, they want to make sure that you also have skin in the game, so they want to know that you're at risk of losing something. So oftentimes they're looking at things like an 80%, the loan can be 80% of what something is valued at. That's a standard one, 80% loan to value, but places have really different ones. And they generally, again, the lower the loan to value, the better off you are. They'll also look at the loan towards how much the entire business is worth, so other assets in the business, or they may look at the loan, and this is sort of, it almost gets back to the debt service coverage ratio, but they're looking at like how much that loan is in payments versus how much in revenues you're borrowing. So if your business generates $500,000 a year, you're not going to be able to borrow $500,000 even though it's paid over time. They will look at these types of ratios, so they're important to consider. The last one, and I don't know if you want to call it a ratio, but I think it's something that's again, from the perspective, if you haven't gone for a loan, is the collateral valuation and generally what we call a collateral valuation discount. So lenders are not going to value your collateral at the market price, at what you paid for it. So if you basically are saying, look, I bought all this equipment, it cost me $50,000. So, I should be able to get a $50,000 loan and pledge this. It isn't the way it works, not only because of the loan to value issue, but because that generally most of the collateral is depreciating. Real estate might be the only thing that kind of doesn't. So it's losing value over time as it gets used, those types of things. But the other part is that they're not in the business of selling these things, and they don't want them, quite honestly. And there is a price that they have to pay to collect. If your business was to go out of business, again, they're seeing things in terms of what happens if things go wrong. If your business goes out of business, there is a cost. There's a cost in time, and sometimes generally they have to hire somebody. There's legal costs to do this, to collect and then potentially sell your collateral, so they will not value it at the same amount. And you can find they'll value different types of collateral different ways. Sometimes they'll only consider 50%. So you basically have to pledge twice the value that you paid in collateral to have them say something's fully collateralized. Most banks don't mind over collateralizing, as we call it, which means taking on more value than something's worth. What you should know is once something gets sold, they can only take the amount basically they generally get for it, and then they would pay back depending if there are other creditors. They would give that money to potentially other creditors. Again, that's getting a little bit into the details, but do know, this is the part where there's friction. Sometimes people say like, oh, but I paid this much for it. No lender generally is going to value your collateral at the same amount that you paid for it or probably think it's worth. And in fact, you're looking at anywhere from a 50 to 75, you'll only get 50 to 75% of the value when they're looking at something. So that's I went through most of really what's the basics for underwriting that I wanted to cover. I do want to just in a few minutes here left before we go into Q&A, talk about things that you should consider to be prepared to sort of get in front of a loan officer and an underwriter. Also, we can talk briefly about there are differences between what loan officers are and underwriters. At most larger places, they are different people. Loan officers tend to be partly in sales. They're generating leads, potentials for loans. They know a lot about underwriting because they have to make sure that they're getting good leads in front of their underwriters. But they are often not the people that, and almost always not the people who are actually doing the underwriting, that are actually doing the financial analysis. The people that are talking to you, they can help you get prepared. They can help you get a sense of what might be possible. But at the end of the day, they generally, in most banks, they'll send it somewhere else to somebody else who specializes in underwriting. And those people, and it normally actually goes through multiple layers of analysis and underwriting. Those are the people that really say yes or no to something. So the people that you're talking to, loan officers, aren't generally the people who actually have the decision-making power. One of the things that's nice about some nonprofits like ours is my staff and I actually both do the underwriting and do the decision-making and meet with you. Of course, we don't have nearly as much money and we do much smaller loans than banks do in general. But there is a difference in that generally when you're talking to us, we're telling you what can be done and what can't be done. And there isn't somebody else in that sort of decision tree. So basic considerations before you're applying, what you really want to get down, before you get in front of a loan officer or an underwriter is how much money do you need? The idea is, how much can I get is not a good answer to that question. You want to know exactly how much that you need, and then how is it going to be spent? Like, what are you specifically purchasing with that? What are you using it for? And then how is it going to make your business grow? I think at the beginning, Robert, I love the fact that the boot camps, it's prepare, plan, and grow. And that's really the same thing that underwriters, like how you prep for a loan. You need to prepare. And this is part about prepping, and then planning for how you're going to use the money and being focused on how it's going to grow and make your business better. Also, the thing you want to think about at the beginning is what collateral do you have to guarantee a loan? If you do not have collateral, there are different types of loans. You are generally going to pay a much higher interest rate when you don't have collateral to pledge. Unsecured loans come at much higher interest rates. And so just understand that when you're looking and you're wondering, well, why is this interest rate so much higher if, in an online scenario or otherwise? Generally speaking, it's because you are not pledging collateral. Nobody can come and they have no recourse, basically, if you default outside of ruining your credit, which they can do. But that's the only recourse versus being able to actually take things that you own back and then sell them off. So these are three basics when you're considering applying for a loan. Things that you need to have done if you haven't already, if you're thinking about this, your business has to be legally established, whether that's an LLC, a sole proprietorship, whatever it is. They're going to look for some legal establishment of your business, lenders and underwriters. Here in Arizona, you're going to need to be registered with the Arizona Corporation Commission and in good standing. You'll need a tax ID or an EI number from the IRS. And you'll need a business bank account. In general, and we are one of those, we will not lend to people who do not have their personal finance and their business finances separated. We help people with all these things, but not all banks do that. They'll tell you to go away and come back when you have these things squared away. Here are documents that you can expect to be asked for. And if you don't know about any of these, like if you don't know what some of this is, there are places that will help you understand this. Again, you can look online, but there are organizations like ours and lots all over the state actually that can do this. They're going to ask you for your business financial statements. They'll generally want 2 years of this will be your profit and loss statement, and they'll want to see a balance sheet. And if you're not sure exactly what those are, we have courses on that. And again, lots of other places have it. You can get individual one-on-one help with these types of things, producing, and not only just producing these, but you should understand what they are. Some people have accountants that produce it, but if you don't understand it, it becomes problematic when you get in front of an underwriter or a loan officer. They want to know that you understand your financials. Business and personal tax returns will be asked for, generally for the last 2 years. A business debt schedule, so all the other loans, all the other things that you owe to people. Bank statements, personal financial statement. Again, as I told you, people will look at both your personal and your business financial standing. A credit report that they will pull, and then additional documentation as needed. There are generally other things that will be asked for, but these are the standards that you'll be asked for when looking at getting a loan. Here's what it is to be loan ready. It's a lot of ands. It's a lot of different things that you have to be, and you have to have all of these really to be considered loan ready. Existing business that has sales and is profitable. Very few traditional debt lenders will lend to an idea or do what's called startup lending. They want to make sure that you actually know your customer base, you have some track record of generating revenue. Ability to prove via documentation of past performance, the ability to repay the loan. That gets into things like capacity, the 5 C's of credit that they'll be looking at. Able to meet documentation requirements from the previous slide. So having all those things, ready to go. Have collateral to secure a loan. Again, you don't have to, but you will pay a much higher interest rate if you don't have any collateral. It's one of the things that we work on is to do uncollateralized loans because we think it's really tough on people that don't already have existing wealth. But most banks are going to ask that you have collateral to secure a loan. And sometimes what's getting secured is the piece of equipment that you're buying, but they generally want some extra collateral. And know exactly how the loan will help your business to be more profitable. Things covered from the last slides. Who's not loan ready? Someone with an idea for a business, but hasn't started a business, not generally loan ready. Existing businesses that are not profitable, or the owner is unsure if or how it's profitable. We've run into that where an owner may not even know whether they're profitable or not. But the idea is that loans are not for getting businesses out of trouble. They're for helping businesses grow. Generally, you can't get a loan if your business is in trouble. You're going to have to fix that first before you can get a loan. Businesses that need funding right now, today, there are some versions of that. Again, you'll pay much higher interest rates, but generally this will take anywhere from 30 days to 60 days. Could be even longer when you need a loan. So if you need something right now, that can be problematic. Again, a business that's in trouble needs a loan to stay open or pay off other debt or to meet payroll. That is a red flag for underwriters. And if you cannot, or you're unwilling to provide basic business documentation, we've had some people that have done that. They're like, no, I don't want to give that to you. Then you're not going to be able to get a loan. So that's really my presentation. Would love to go into Q&A. Here are some resources. You can get help with loan preparation. That is different than business education. Business education is a little more general. Business educators can help you find somebody or can help you with some basics of loan prep for sure. But there are groups that actually do the lending, like mine or Prestimos or Growth Partners Arizona, that are places that are going to be able to tell you more specifically what you need. Again, a little more on the 5 C's and some of the key ratios. This will be sent out after this presentation.
Excellent. Thank you, Danny. So let's jump in. We've got a handful of questions. There's some contact information for Danny's team, so we'll leave that up on the screen while we do the questions. So as we jump in, the first one I want to ask, it says, to build credit worthiness, do you recommend looking into loans that are backed by your own cash collateral?
Sure. I mean, to build credit worthiness, any sort of idea of taking out a loan and repaying it helps to build your credit. Again, you want to understand that both your personal and your business credit are important, though. Sometimes I think that people kind of miss that, but absolutely. And generally, it's advice that you probably should take, which is the best time to get a loan is when you're not desperate for a loan. And so that idea of like having, creating some cash, yes, you wind up paying for it, but it can be more helpful to get it when your business is looking good and doing well, to have extra cash on hand and to be building your credit over time. But again, that's a personal and individual decision.
Yeah, and I'm glad you mentioned that, Danny, because that was coming up in my mind as something to share. And I've seen many examples of someone they're going to expand their restaurant or expand their business. They've got the build out plan. They start spending their money on the build out, and then they run out of cash. Their business is, they have all the stuff that would get you a loan, but once they run out of cash, it's that much harder to get a loan. And so you want to, if you're going to do that type of expansion, get the loan for the expansion and keep your cash handy for when you really need the cash.
Yeah, I think that's right. Like it can be counterintuitive too, because, and Jacqueline said something about this earlier on about, we're told to bootstrap and do everything we can. Bootstrapping is basically finding and using your own resources to get something done. But if you can create some sort of cushion, even if you're paying a little bit for it in interest, that does generally, you're better off for that. That doesn't mean just go out and get a loan willy-nilly. Have an idea that sometime in the future, you're going to be getting ready to do something. And that oftentimes will help you in terms of your credit worthiness. And you can, depending on what you've taken out, you can pay that back with loans, depending on, there'll be lenders who will take out some of that debt because, and this again, it's a little gets into it, but they want to have first position on your liens and those types of things. So anyways, this is something good to go talk to a lender like us about, because it's a little more complicated.
All right, next question says, I'm looking at buying a franchise and will need financing. I am considering asking for seller financing. What should I consider when comparing traditional term loan to seller financing?
Generally, seller financing is at a higher interest rate. And it's really the terms you have to look at. What is it that they're asking for? It depends. Sometimes there's a very, I don't want to say hungry or desperate seller who may seller finance and give you a good deal. But otherwise, in general, people are going to charge you higher interest if it's seller financing. This is one of the things that we get into. If you can't meet all the qualifications for a loan, a traditional loan, then you wind up in this kind of other arena that's a little more the Wild West in terms of lending. There aren't nearly as many protections that are in place. So it would be, if you, depending on what you understand about finance, you should find somebody that you know that really understands lending. Hopefully you have a friend or somebody else who could help you look at a seller financing option, because they are normally skewed, quite honestly, towards the seller. That's, what they're doing is they're saying, like, well, if you could get a loan from a bank, you would get a loan from a bank. And if you can't, we are going to charge you higher interest and have stricter terms on it.
Yeah, and in this one that mentioned franchise, if it's an established franchise or a certified franchise, you can often get SBA loans
Yep.
that the SBA will back because the franchise itself has a track record of success. And so some banks will loan based, through the SBA based on that track record of the franchise success. So that's a good question, and you may want to reach out to some of those resources that Danny posted on that previous slide. All right, jump to the next question. We have, where can we look to find courses your business offers for understanding and preparing financial reports?
Our website is a good place. We have, much like Robert, we have different courses that are actually videoed and online, and we also do them periodically. So if you want to participate in a live one and be able to, ask questions on the spot. And again, there are a number of groups around that do this type of work, depending on what you're looking for. SCORE is a place that does some of this. SBDCs, depending, their small business development centers. They are great places. They do an amazing job with loan preparation. Unfortunately, at times, and it depends, in rural areas, I think they tend to work with some smaller businesses. Sometimes in the urban areas, because of their metrics, they want bigger loans, but they will often know some of the other partners. What's nice about this ecosystem is that if you hook in with almost any one of us, if we can't provide what you need, we know of somebody who can, and we will sort of put you that direction to help out. So the nonprofit world and sort of the government world that works in this space is really here to help. I'm not saying the private sector isn't, but they may have some other things at play, whereas we will really look to find you to get you to the right place for what you need.
Yeah, and then you can also, as Danny mentioned, look in our content library. We've done a number of our bootcamp webinars on financial reports, how to prepare them, how to read them, and some resources that are out there for you to help. All right, so let's see. Next question, we've got, I am planning on starting a business with credit cards and potentially applying for a loan to help pay them off later. Is 12 to 18 months a good timetable? Is this a common advisable or recommended approach for someone without a business track record who likely will not receive a loan from the start?
It is pretty common, quite honestly, to bootstrap with credit cards, if you have them, depending. I mean, the issue is always, and I think this is something to consider. You always want to make sure you have enough money to cover whatever you're doing. It's one of the things that we don't like doing when somebody asks for a loan amount. We don't like giving them less. We'd almost rather say no, because if they need a certain amount, you need that certain amount to hopefully be successful. Sometimes when you bootstrap with credit cards, you really need to pay attention to the cost of them, because they're at higher interest in general, and what it's going to cost you on a regular basis. Making sure that you're paying some of that off. I don't think you just necessarily, people have done it. I just don't think it's advisable to get crazy and go out and max out all your credit cards unless you have a really good game plan. But it is common to do. And again, you're going to have to go for 2 years of performance. That is really the standard. You may get away with less than 2 years with some nonprofit lenders, but I don't think that's a great again, I don't think you should be overly optimistic. You should be planning. You should always be planning conservatively financially. So you're going to have to do that for at least 2 years.
And Danny, one thing I always recommend, because it never hurts to ask, but when you go in and you establish your business bank account, ask for either a small line of credit at that
Yep.
moment, and small, maybe it's $100, but it's $100 you can use and pay off and use and pay off and use and pay off, and you build credit with that bank. You build credit, and so you might be able to show with your bank that, hey, I'm worthy to continue to up that line of credit over time, to help avoid using some of the high interest credit cards. So, and it's easier to ask for that when you first establish your bank account than months later. So,
right. Yeah, a lot of people, bootstrapping is a lot of people, it's like savings, credit cards, but also, people say friends and family. And again, this is one of the things we work on because, people with less resources don't tend to have friends and family that have more resources too. So it is harder for people of lower incomes and lower wealth to start businesses, even if they have a great idea. But those are also the other places to look, is if you have friends and family, to be able to ask them to loan you money as well. Although there's obviously problems with that too. There can be problems caused by borrowing from friends and
okay. All right, we got a few more questions I think we'll be able to get to. One is, it says, hello, I was curious what would BIPOC loan, how do you determine how much percent of color you would need to be? My mom is Middle Eastern and my dad is white. I look white, so would I not qualify?
So we have it, and for people who don't know, we run a BIPOC loan fund, and really it's a committee of BIPOC community members who have established this loan fund to help BIPOC entrepreneurs. There are lots of reasons why it's been more difficult over time for people of entrepreneurs of color to get access to traditional financing. It's our focus for this one BIPOC loan. Basically, they'll ask you what you identify as, and again, this is what's interesting about it, and I don't mean to duck the question at all. I have no say. This is a committee of community members who are helping to fundraise for this. They're all identify as people of color, and so you have to. I basically say, what do you identify as? You would tell them what your experience is. A lot of it is around the story that you tell, and so that would probably, in my opinion, that would qualify. But they tend to be pretty open in terms of what that is, in terms of who qualifies. There's not like not like the Olympics or other, like to be able to play on another national team, you have to have a grandparent or something like that. That's not necessarily how they look at it. They want to know how you identify.
All right, and then we'll be able to squeeze in one last question, even though it's right at 10 o'clock, but this is a really good one. It says, would a nonprofit lender be more interested in lending to 501c3s than for-profit businesses?
There are some lenders who work specifically with nonprofits. So like Growth Partners Arizona has part of their portfolio. They would be a good one to look at. They may be. There are some issues with lending to nonprofits because it has to do, again, with how much money you have coming in and how people, whether you have a donation track record, like how steady that donation track record is. Also, there can be issues because for getting a loan for a nonprofit, you have a board of directors. It's not a single person who's necessarily responsible for something. So, yeah, somebody who specializes in that. And again, I'm going to give a shout out. There are probably others, but Growth Partners Arizona is a really good place because they've done this. They can actually also do some consulting to help you look at potential for giving. But any bank will give a loan if your financials look good enough. They're just going to be less impressed by the social good that you're doing necessarily. They're going to get down to, can you repay the loan? And that sort of maybe that's a good place to end. That's what they underwriters want to know. They mostly care about, can you repay the loan?
Yeah, excellent. Thank you, Danny. So, we touched on nonprofits too in this, so it's awesome. I want to thank everybody for being with us. We're a little past time, but that was a great question to finish up on, so we wanted to hit that. Again, we appreciate everybody being here with us this Tuesday. We hope you can make it next week. And until then, everybody have a great week. And again, Danny, thank you for being with us. And we'll talk to everybody soon. Have a great day.
Thanks so much.
Bye.